What's up? What's up? What's up, everyone? How you guys doing? How you guys doing? Can you guys hear me? Can you guys hear me? Well, I'm using my earbuds. So I'm just checking with the powers to be to make sure you can hear me. Doo-doo. Anyway, um, my name is Jeremiah Davis, aka the Funding Coach, coming to you with Black Label Friday. And today's topic is understanding business funding. Now, for all those people who have the software currently that are not getting a good understanding of, you should get a good understanding by going through the training within the software. So if you're going through the training in the software, then you should be getting a better understanding of the loan products in the software. Okay. But I think I'm going to do a series. This is going to be part one on understanding business funding. And quite frankly, there's a lot of people out there that think they understand, but most people don't. I'll just give you that right off the top. So if you've been out there spinning your wheels trying to submit loan applications and not getting approved, hopefully this will help you. The series that I'm going to do, Understanding Business Funding, probably going to be about 4, maybe a 5 or 6 part series because there's a lot. There's a lot to it. And quite frankly, I don't have the time anymore to handhold, babysit, do type of one-on-one free coaching that a lot of people try to, call me, hit me up, DM me, talking about, I got a guy who needs $1 million. I got a guy who needs, $15 million, or I got someone, okay. And here's the thing. I created a course under Business Funding Now, a business funding certification course that covers 30 different business loan types. Okay. And there's a lot more than that. So it's not about, everybody needs money. Every business owner needs money. They need more money to expand, to grow, to hire, to buy more products and things, to service the community. So that's not the problem. The problem is the expectation and knowing the qualification requirements. All right. And this is how I'm going to just simplify it as much as possible. Right. You basically got 3 silos, okay, funnels, silos for business funding. You have credit-based business funding, you have asset-based business funding, and then you have equipment-based business funding. Now, there's asset and equipment kind of cross over in some areas, but point being is every one of your clients or every business owner is going to fall into one of these categories. All right. If they're not in one of these categories, they're going to fall into more of a personal type funding option. So, um, let me just repeat that. You got your credit-based funding, business funding programs. You got your asset-based business funding programs. You got your equipment-based funding programs. So, by asking the right questions, you can pre-qualify your client into one of these silos. All right. For example, if they don't have a 680 credit score or higher on all three bureaus, with a clean credit file and a strong credit file, just not the credit score, it's a credit file. If that's not, if they don't have that, then they're eliminated from credit-based silo programs. They're not going to qualify for anything that relies on credit. Okay, so that eliminates about a dozen different loan products because they don't have the credit score or the credit or strong credit file. Okay, so that means that now they're going to fall into the asset base or the equipment base. Now, asset base is a wide range of things. Anything can really be an asset. Number one asset is cash. The cash flow of the business is the number one asset. So if they got a 650 credit score, but they make $100,000 a month, then they can borrow, 50 to 75, maybe even up to $80,000 when they're doing $100,000 a month in volume. But they're going to pay a high interest rate because of their credit is below 680. It's simple, but they can get money. Okay. Another asset is anything that's recurring, accounts receivable, invoices, things like that. Inventory can be an asset that you can borrow against. Any equipment, office equipment, heavy equipment, warehouse equipment, if there's a value attached to that, and the bank or the lenders see the value. If you have $100,000 in some type of equipment or inventory, accounts receivable, purchase order, things like that. Another some of the contracts, right? Government contracts, city contracts, school contracts, are all can be assets as well. Okay, patents can be if you have a patent on a particular product or service that is recognized by the United States Patent Office, that could be an asset. Or raw land, houses, commercial buildings, property, even your primary home can be used to borrow against in business funding by using the equity in your assets. That's what we're doing. All asset-based funding, right? Now, outside of the cash asset, all the other assets are going to could be approximately 50% loan to value, meaning the if your asset is valued at $100,000, then you can borrow $50,000. That because here's the thing, the bank or the lender is going to sell if you miss a payment, you can't keep up with it. They're going to sell that asset at a fire sale and get their money back. So they're going to hold on the asset and try to sell it at full value. So that's why they're only going to lend you 50% of the loan to value. Okay. So that's one thing. Okay. Equipment is another asset, but you have equipment purchases and then you can have equipment as a collateral. So to get purchase equipment, you don't need a good credit score, but you do need to have approximately 10, 15 to 20% of the purchase price as a down payment, as well as any other related things that need it. A lot of equipment we do is tractor trailers for owner operators. So they got to have 15 to 20% of the purchase price, say it's $100,000 tractor trailer, then they're going to have $20,000 as a down payment. Okay. And then they're going to also have to have the proper insurance, the proper tags, everything that's related to them operating that tractor trailer, DOT tags, wherever those related things are that are needed to operate that tractor trailer, they're going to need. Now, if it's not a tractor trailer, say it's a food truck, all right. Well, you have your food, your license, and all those things like that. But you still need to have 20% down. Okay, so those are the type of things you need to think about, right? So when I'm asking questions, man, I have a 5 question formula that I ask every potential client so I can weed out which loan products they do not qualify for, and then I can put them into the product that they qualify for. All right. So my questions I ask are like, you know, how long you been in business? If they've been in business less than 1 year, there's a lot of funding options that are not available. You have to be in business at least 1 year, sometimes 2 to 3 years, depending on the loan product. Okay. I ask them what the credit is. If the credit's below 680, then I know these set of loans, credit-based loans, are not available to them. All right. How much do you make a month in your business? If they don't say more than $10,000 a month, then they're only down to like one option. Okay, so things like that. So that's how I kind of weed out the clients, or this is a process of elimination to get them into the right loan product that they can qualify for. Okay, so that's just an example of how you need to understand business funding, is to understand what the business owner his needs are and what their situation is to determine which type of loan product they're going to qualify for. All right. Now, the biggest thing that most people do not know, right, are what the requirements are to become bankable, right? We use this term, bankable, because if your business is bankable, then banks want to give you money, right? Because you check all the boxes and you cross all the T's and you dot all the I's. But most people are not bankable. And I'm going to go over that with you today. What are the criteria for you to be bankable? Okay. Now, this criteria is not an easy feat to achieve, but it's very possible to achieve it. Okay. So let me go ahead and jump into it right now. Pull it up. Now, this is just part one. Okay. I'm not going to be here before you long. I'm not going to give you a wide range of funding products, a bunch of information. I'm just going to give you the basics, right? What you need to become bankable. Okay. So we say within our software community, the Black Label CRM community, that there are 4 legs to becoming bankable. So 4 legs to a table. Right? Most tables have 4 legs. All right. My desk has one centerpiece and then 4 legs coming out. But hear me out. We got 4 legs to a table. Okay. So the first leg is lender compliance. Lender compliance are 20 items that are your business credit foundation, is what we used to call it. Now I call it lender compliance because that's what lenders are looking for to extend lines of credit and or funding. Okay. So, but the 20 items of lender compliance are, your Secretary of State, your phone number registered with National 401 Directory, your business listed correctly with the Secretary of State at the IRS, with your business address, not a residential address. So all those different things, having a business bank account, having a website, having social media footprint. Lenders are looking at all these things now because there's no serious business that does not have a website, does not have social media, right? So if you got poor web presence and a poor social media footprint, that could be a reason for decline. Okay, if you don't have all the items of lender compliance, they can use any of those reasons to decline you. Now, this has become bankable funding, not the alternative high interest, revenue based or asset based funding. This is for credit based, right? So to become bankable is under the credit based program or funnel or silo, whatever you want to call it. Okay, so if your client is not doesn't have all those 20 items in under compliance, can check all those boxes, they're not bankable. Okay, they're not bankable. That's in the story. No more discussion. That's it. All right. So there's 20 of those items, and we have those listed in the software. And then we also provide you resources to complete those steps in the software. So if you're a software user and you have your clients coming in, then you want to make sure you reiterate how important that step one lender compliance and the 20 items in lender compliance need to be completed. All right. I went over, 4 or 5 of them, but there are 20. Okay. I mean, even everything from we cover everything from even your backlinks on your website, your things like that, your SEO, all those things that lenders want. They want to see a business that is strong, that that's out there, that's generating revenue. You got to make these lenders feel like you're not a risk. Okay, if you have missed any of those things, they can use those for as a risk factor. This is for becoming bankable. One leg of becoming bankable are 20 items of lender compliance. All right. Now, the next thing is the bank rating score. Now, I've talked about the bank rating score many, 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 many times. And the bank rating score is what banks check. Okay, any lender, any bank can check your business bank rating score in seconds. All right. Now, it costs them money to check that, but they're going to pay that little couple few dollars to check your bank rating score. And 9 times out of 10, you do not have the bank rating score that's required. Right? We cover this in the software. What you need a low 5 bank rating score. A low 5 bank rating score means that your daily average balance in your business checking account over 90 days is $10,000 or more. Okay, now it's from 10,000 to 100,000. So a low 5 is 10,000 to 20,000, and then 20,000. A mid 5 is like 20,000 to 100,000, or somewhere around there, right? If you're over 100,000, then you're in the low 6. All right, then you're good. If your daily average business count is over $100,000 a month over the last 90 days, you're going to have more funding options. Okay, now hold on. We're talking about bankable. We're talking about 4 legs. Okay, if you're in the 4s, right? So a high 4 is up to 9,999. Okay, 10,001 is low 5. So if you're in the 4s, you're looking at 1,000 to 10,000 or 9,999. That means you're either low 4, mid 4, or high 4. Okay. Now, if you're in the 3s, that means you're between 100 and 1,000. It's your daily average balance in your business checking account over 90 days. Now, you might have $50,000 a month coming into your business bank account and going out. So, what is your daily average balance? That's what the bank rating score is, your daily average balance, and it's calculated over 90 days. So if you don't have a low 5, you're not bankable. Okay? I don't care if you're doing $1 million a month and every dollar going in is going right back out, and you don't have that $10,000 monthly daily average balance over 90 days, you're not bankable and you're going right back into the asset-based silo. All right. Number 3, having comparable credit. Does your business have a reporting credit trade lines that is close to the amount that you're asking for? It's okay. Now, these are trade lines equal and collectively equal to the amount. That is business lines of credit. That is business vendor accounts, things like that, right? You need to have access to $100,000 or $250,000 or whatever it is that you're looking to get. Now, here's the thing. We show you how to build that comparable credit in the software. In a very, you can actually have 100, 250 $1,000 in comparable credit in about 6 months if you follow the protocol, if you follow the instructions, right? Um, and once you have that comparable credit, now the chances of getting approved when you walk into a bank and ask for a business term loan are more higher than not. If you don't, you're not going to get it. You're not bankable, and you're going right back into the asset-based funding arena. Okay, so that was number three. Number four. This is the most I, I would say most important, but they're all equally important. Okay, so the FICO SBSS business credit score, right, or your small business FICO score. Okay, this is the only score that lenders look at when they're doing cash loans. They don't look at Paydex. They don't look at, Experian Business, Equifax Business for credit's sake, right? Those are the four major business credit bureaus that you need to make sure you're reporting to, your trade lines reporting to, because those are general business reporting agencies, right? They're not niche market specific. All right, those are the most popular ones that lenders and creditors report to. Okay, um, but the SBSS score is what the SBA looks at and what lenders look at. So to get an SBA loan, and for not all SBA loans, but most of them, you need to have that SBSS score or small business FICO score of 160 or higher. Now, the 160 basically means that your personal credit is above 680 and that your business credit is above 70. All right, and they put those together and they come up with a number. I'm not sure exactly how they come up with the number with the 680 and then the 70 on the Paydex or intelligence score, but you need to know and check. I believe Experian Business offers that score as well, so you can check your SBSS score with Experian, I believe, but Google it and know for sure before you pay for anything. Okay, so you need all four of those legs, right? 20 items lender compliance, low 5 bank rating score, comparable credit, and the small business FICO score of 160 to be considered bankable. You see what I'm saying? You see what I'm saying? Okay. Um, Now, other vendors, when they're offering or you're applying for business vendor accounts, trade lines, things like that, they may check those other credit bureaus and not the SBSS score of the small business FICO score, but them when they're extending, but for cash money, this is the most important business credit score you need to be aware of. Okay. All right. So, um, you know, pulling credit reports costs lenders money. So, without spending any money, a business lender's computers can scan about 150 data points on your business in seconds, and this will instantly give them, let them see if your business has the four legs to become bankable. If not, you may still be approved, but the amount may be lower, and the term much shorter, and the rate much higher, which means you're unbankable because you're going to pay a higher interest rate. You're going to get short. You're not going to get the deal you want. You're not going to get the low interest rate, the long-term repayment plan, and the higher dollar amount cash. Okay, so that's part one of the series. All right, the four legs to becoming bankable. Every business owner should know. Every business owner should achieve to. When you have these four legs, and maintain them. You have to maintain them. You have to maintain your 20 items lending clients. You have to maintain the low 5 bank rating score. You have to maintain your big comparable credit, and you have to maintain your small business FICO score. Okay? If you let one lax, okay, and don't ever be late on any business trade lines. The only thing they are calculating that business credit score is your timely payments and and the type of cards or vendor cards accounts that you have in the business name, right? If you are not on time, you're shooting yourself in the foot, and it's going to take you forever to be get that rectified and become bankable again. One day late equals 30-day late on your business credit. One day late on playing a trade line equals a 30-day late reporting to your business credit. Now, and that doesn't, no, there's no governing. They don't have to remove it. They don't have to do anything. Okay. Now you have to work with that creditor, get it paid, and see if they'll remove it or close the account and get it removed, or something else like that. But 9 times out of 10, when you have shot your business credit, and for one business, you have to start all over with a new entity. Okay, unless I mean, business credit is a whole nother topic. I'm not going to get into that. Business credit repair, I'm not going to get into that because it's really not a formal thing like personal credit. It's more of you and your tenacity and contacting lenders, getting your reports, and staying diligent to try to fix it. So those are some tips that I want to give you guys. And listen, you know, the banks want to lend you money. I mean, that's how they make money, by lending you money. But if you're not, you know, if you're a risk factor, they're not going to take the risk. And you're going to forever live in the unbankable space, in the asset-based lending area or silo, and you're always going to get, high interest business loans. As simple as that. Okay. All right. That's my time for today, ladies and gentlemen. I hope this was helpful for somebody. Catch me next Friday. Well, I'm going to come back with part 2. All right. Like, follow, share, all those things. If you want to see any other past videos, check my YouTube channel out. Let me go ahead and pull that up and drop that in the comments, because I got a couple of years of content on the YouTube channel. And it's a lot of real good information. I mean, literally, I spent almost 20 years in this space studying these things, and I keep updated. I keep trying to keep updated with all of the changes in this arena, because it's not regulated and governed. Lenders can change things. I mean, for example, one of the big changes that I've noticed, one of them, there's several, but one of the big changes that I've noticed is before the pandemic, you needed 8 trade lines to have strong business credit. Now, all lenders and creditors for the top tier programs of tier 4 type accounts, or the business term loans or things like that, business lines of credit, you need 10 to 15 trade lines reporting to your business credit. Yeah, not 8. You need, and the creditors have changed their protocol. They're not reporting for one purchase and payment. A lot of them are requiring you 3 consecutive months of purchase and payments. So it's more important now to get the trade lines that you need to use on a recurring monthly basis, and still do that $75 to $100 purchase every month for 3 consecutive months to get them to report. So by the first month, you should have those 10 to 15 trade lines reporting, right? But also, the more you use those trade lines, the higher limits they're going to give you, which goes towards your comparable credit. And you're going to stop using your operating capital, which increases your bank rating score. See what I'm saying? So the more you use business vendor accounts and credit lines of credit, things like that, the more fortified, financially fit your business is going to be. And that's 2 of the legs: comparable credit, building that up, and bank rating score, building that up. So, hey, watch out. Here we come. My name is Jeremiah Davis. I'm the funding coach. Peace.